Thanks a lot for waiting or helping us delay things a little bit as the news from Jackson Hole has been coming through. But as you've probably seen, it looks very positive, at least in liquidity expectations. Henrik is obviously going to tell us a little bit more about what he's seeing there on the structure. Willy will follow through with the deep liquidity analysis framework that he has, and then we'll end it with the Hawkeye like we always do. In the meantime, I will just quickly give you the usual disclaimer, right? So you guys know that the opinions that we give on this webinar are basically for educational purposes. They are intended to give you an overall view of how things are moving and how things are changing, and they do not constitute a specific financial advice, right? So these are our collective opinions built around the frameworks that we are working on together. So I guess with no further ado, do we want to start, Henrik, maybe giving a high level on what's going on here?
Yeah, sure. So today now we see that the markets are reacting to liquidity, to the expectation of liquidity. Now that is always the same. We know when we get late phase in the business cycle, and just make no mistake here, because when Powell comes out and speaks of let's say easing, then and have to balance their view on things, then it's because they start to observe the weakness that is in the labor market, and that has been quite clear, as I said before, when we have the leading indicators in the business cycle model crossing over, telling us that now things should start to deteriorate in the coincident indicators. Well, then it's just a matter of time before they do. And for quite some time, I've said that we should see the coincident indicator starting to weaken. And every time we got non-farm payrolls, I got a kick in the stomach, because they stayed high. May was good, June was good, July was good, and then all of a sudden we got here in early August. Or actually, July was not so good; it was 73,000. But anyway, we saw that we had the revision, and now I see Goldman Sachs also talking about we could maybe even get a lot larger, maybe the largest revision on a yearly basis or half-year basis, when they do that in September, I think it is. So things are developing as along the business cycle, and this is what is interesting here, as I see it, that we have had all the signals in the leading indicators telling us that this is going to come, and now we start to see it. And again, as I said, make no mistakes. It's not a free, early present, Christmas present from Powell here. That's not why he does it. It's because the economy is actually hurting, and that is not the hurt that you see when you look at the crypto market at all. You look at the stock market. Absolutely not. That's when you look at the real economy. The real economy is Mrs. Johnson in the U.S. or Mrs. Jensen here in Denmark, who are, not just feeling the pressure of the high rates of inflation and everything like that. And no matter how much anybody tries to tell us that it's about what the Fed is saying, or their, three letters abbreviations or whatever. It's not about that. It's about the real economy. And the real economy is about delinquency rates moving up. It's about people having difficulties in the US, also just, making ends meet, and to just, put food on the table, which is now up at 15.6% of the US economy seems to have, severe troubles in just putting food on the table. That's the real economy. And this is what the Fed is missing over and over and over. And they sit and look at their inflation numbers, which are hopelessly lagging. And they look at the labor market and say, "Oh, we will step in if things are starting to decline." What we have seen is it actually happened already. It happened in May, and they are really, really low. Those 14,000 or 19,000 could easily be zero or negative. So we already have that situation. So the Fed is not on top of their game, and that's what we see now. And then the market starts to anticipate, hey, they have to come in with somewhat of some kind of force here. Now they're starting to realize it, and that's the liquidity part. So what I think we're seeing here is now it's the final dance. It's the dance where we have seen the Titanic has hit the iceberg. It's going to sink. There's no doubt about that. And the Fed will not try to prevent that. And there will be a lot of music, and there'll be drinks at the bar, and people will run in there, and there'll be nice party. And a lot of will not believe what I'm saying when I say this is going to come to an end where it's going to be cold in the water at some point. So we're seeing this developing now. So liquidity coming in, and everybody will party, and the markets do not drive the economy. Just look that up. It's the real economy that drives the market. And when the business cycle returns and the unemployment starts to roll up, that's when you see the liquidity comes in, and then you have the final blow off top. And this is the blow off top. We are now starting to see the first phases of, we actually been in it, but we're seeing the next more explosive phases of it. That's how I see it.
Great. Shall I share a screen here? It's obviously a lot of the work that we do here is to actually track liquidity. Share that. See if that's working for everyone. Yeah,
Yeah, we see it.
Okay,
We see it now. Yeah.
This is our estimation of liquidity hitting the Bitcoin network. It is relative to it's relative to effectively the size of Bitcoin, the market cap as it rallies up. So we're definitely in that later phase of the bull market. You can see that every time as relative liquidity against the size of the network starting to drop away, then the clock has started for a top. And that happened in, what was that, back in December last year. And so bear in mind that, the fact that it's dropping off doesn't mean that we're in a bear market. It just means that the clock's ticking. Actually, some of the biggest moves are when it starts dropping off. You can see this in 2017 where it started dropping off pretty much at the start of the 2017 bull run. What it does mean is that things are going to get volatile, often to the upside. The downside pullbacks can be large, but as we approach the top, it does get quite unstable as liquidity falls away. So that cushion to keep the drawdowns low as the price sort of goes up and down starts to fall away. And so we always say tops are unstable. So one thing we can gauge is we are late stage, and we're past this dotted line. This dotted line is kind of a line historically where it's relatively confirmed that we're heading into a bear market. And so you can see if we zoom in here, let's bring the price in down a bit, that this stability inside the liquidity metric here was coinciding with the run up that we have. So any kind of stability within liquidity in this phase will serve to rally us upwards. And so that's what we're really looking for. Another view of this is our risk signal, which is really driven by this liquidity model. And we are seeing a little dip right now. Actually, this is before the latest refresh, but this dip happened a number of days ago. So that made me a little bit more confident that we weren't going to break down here, that liquidity is coming back in. And if I refresh that chart, we're back at 115. Let me just pull that up. So, and then while that refreshes, I'll come back here with another view of liquidity. This liquidity is effectively measuring or estimating the capital flowing into the Bitcoin network, just in sheer billions of dollars per day on the y-axis, 1 billion, 2 billion, 3 billion, and so forth. So, I somewhat discount measuring, Michael Saylor's buying in strategy and the ETF. Well, we have a ability to measure it across the entire network because of Bitcoin's UTXO model. And so using on-chain, we can capture the inflows coming in, which is the entire system. And so we did get this bearish pivot as we rallied to all-time highs and sort of consolidated, but it did drop down, and right now it's stabilizing. And we said that the leading indicator is rising, meaning that this expected stability and rebound should happen, and it's right now starting to happen. This is before leading up to today's news. So possibly people were already seeing this happen. And so overall, the liquidity situation looks okay. It's stable. I wouldn't say what we're scared of here is if the capital flows start to continue to break down, that's a proper bearish situation. And you don't want to be in a bearish situation having had a previous high and printing a lower high. And that's creating a new trend or a bearish divergence on the capital flows. And the last time we did that was actually the cycle top of the last cycle where we peaked, and then the capital flows didn't follow through to make a higher high, and we fell away. And so fortunately, our leading indicator, which is much more responsive, did print a higher. So right now the situation is stable, and there is promise with this risk signal dropping. We can move higher at this point. So if we want to zoom into a little bit more of the tactical view of what's happening in the system, we can see that, let me turn off some of these traces so that we can, maybe let's look at SOPR, right? The green trace is SOPR. In basic terms, we're measuring the profit that is being transmitted from the people who are selling to the people that are buying. Are they selling at a profit or a loss? We measure that, and we look at the overall ratio of the profit versus the loss. And generally, people selling at a profit. Obviously, Bitcoin's a network which is increasing in value with those coins. And we were in a situation where profit taking was happening, where the profits and the coins were reducing, which is indicative of profit taken. And that has stabilized. The sell-off pretty much stopped here as we were coming down, so that was positive. The problem that we had was that as Bitcoin rallied to this new all-time high, the speculators were not in the game, but they rushed in very quickly, and kind of after the fact of the pump, expecting another leg up. And in that regard, it creates a headwind for the price. It's very hard for the price to climb when there's so much speculation going on, bias to the long side, because it becomes an incentive for other people to come in and liquidate them. And so that's what happened. We've been cooling down. Speculation is still very high. I don't like that setup. But given that the fundamentals of SOPR and the profit-taking ending, that's helping. Liquidity is improving, meaning the real investors are coming into to buy into this network. So the fundamentals are strong. I'd like to see the speculation come down. Maybe that can come down more with some liquidation of the short positions, as we've just had this rally. Let's see. But one of the unusual things to see happen is this move upwards was, if we zoom in a little bit here, if you look at this entire move upwards, from here, this zone here up to the all-time high was driven not by new capital coming into the network, which I showed in the capital flows here. If we were to zoom in, you'll see it was very, very flat as we rallied up into this zone here. Get this chart looking a bit better. As we rallied up, there was really not driven by any new capital coming into the network, showing this purple phase. So actually, it was driven by liquidations. And as we were liquidating those short positions, speculation kept increasing, meaning long positions were being put in, chasing the price, going, we're going for it. And ultimately, the whole thing, because it wasn't backed by fundamentals of new investors and liquidity coming to the network, the whole thing switched, and it was very easy for the price to be driven downwards and then liquidate all those new long positions that came in. And now we're finally purging these positions. So I hope to see more of that. I think that our current setup here is promising. Liquidity is turning around. We can be in a situation to break new highs moving into the later phase of this bull market. I do expect a further upward movement, similar to what Henrik's saying, that the blow off top has not happened yet. We're still running into it. I think there might be a little bit more time to run. If speculation comes down, Profit taking is, if the profit in the books aren't too high, then we're in good shape. So let's just see how that resolves in the next few weeks. But right now, what I read is that structurally we're recovering rather than breaking down. Over to you, Yann.
Yeah, I actually fully agree with that perspective as well. And what's also very interesting for those of you that actually subscribe to the Vector series, follow us on Twitter, is that there's a little bit of a dichotomy that is happening. You have Bitcoin having been really the dominant force over the last couple of years, with that actually seceding to some extent with Ethereum. And I think Ethereum, it's really been a tale of two coins really this year, right? You had at the beginning of the year Bitcoin taking the kind of the lead in the downside, right? Really pressing or kind of subduing a lot of the capital rotation that actually ended up going into altcoins for a very short period of time in January, and then rotating into stable coins. And now really having Ethereum kind of being the phoenix that rises from the ashes again, really leading the charge. And we're seeing this across the board. Even for those of you that actually have the altcoin vector advanced, you saw that even in a very downward tactical type of environment, you still had a positive impulse in Ethereum. And that is significant. The last time that actually happened, to give you a relative perspective over the same amount of time, was back in 2021. So you've actually not seen that relative strength in Ethereum for a very long period of time. And I wanted to maybe contextualize that a little bit before we go into the weeds with Hawkeye, in terms of actually what that actually looks like from a liquidity perspective, kind of taking kind of continuing off where Willy mentioned with this capital rotation chart on Bitcoin, and showing you how that actually looks like with Ethereum and Solana as well. So that you actually see what the capital rotation actually looks like. Are you able to see my screen here?
Not yet, Yann.
Not yet. Okay. What about now?
Now we
Yes.
can, yeah.
Okay, super. You can see my presentation, right?
Yes.
Yeah. So, before we even get into that, so the reason we postponed the current webinar by 45 minutes was the Jackson Hole meeting, right? So we wanted to make sure that we would be able to give you the most up-to-date view on liquidity expectations, something that Henrik mentioned at the beginning of this webinar, because that is the story. Everything else is a consequence of understanding where liquidity is going, right? So you have things like M2, which you guys are probably very familiar with because it's been very widespread or talked about in a very widespread way on Twitter. But there are other more intricate things that happen on chain and on the order books that we need to be considering, because those tell you about the shorter timeframes, right? In terms of how you actually position, risk reward, these types of things. So I think what's very clear for those of you that haven't seen the Jerome Powell speech of Jackson Hole, I wanted to give you a quick summary in terms of what that actually entailed. And it basically was three concrete things. One, economic outlook, the framework update that the Fed is using to make longer term decisions, right? And things that influence the longer term or the term premia further out into the risk, into the yield curve, and also the actual tonality of the policy approach, right? So those are three things that the Fed usually mentions and talks about. When it comes to the economic outlook, it was basically a clear understanding that the inflation is still above target, but there's a recognition that it was actually seceding and that it might actually likely be more of a short-term thing, where the recognition of a weakening labor market was actually being taken at face value for the first time. And I think that was one major key input. And that actually may warrant an actual rate cut. So remember that Jerome Powell over the last couple of meetings has basically stayed away from giving concrete feedback on rates, other than when he was asked by a reporter. This time it was a lot more proactive, right? There was actually including that in his remark. The second, on the framework update, there was a clear intent on the longer term view now of the economy as well, right? So not just short term impacts of how basically monetary policy can impact short term liquidity expectations, but also how that has a longer term impact and the longer term view in terms of how they look at things and how they see things. I think that was also important. And with that as well, the tonality on the third point, which is more on the policy approach and the tonality, that reinvigoration of his stance that the Fed is an independent entity, that it does not get manipulated or pushed around by a third entity, which in this case would be the President of the United States, and that they would be making decisions with a balanced view on all of these points that lead into the economic outlook and the framework updates. Okay, so I think a retaking or a retake of the initiative that the Fed really has. I think this is super important because the economy, especially the markets, they respond to clarity and decisiveness. One of the things that people underestimate, and they always look at rate cuts and that being the reason that markets move. Markets actually historically also move or have moved the strongest, and Henrik has mentioned this many, many times before, with actually high rates. The reason for this is that markets like certainty. They like having the ability to be able to project forward and actually look at things on a more mid to long-term view. Okay, so the Fed has actually brought that into full focus. So what does this mean actually for us on a structural level? So for those of you that are in our Vector Advanced series, we talked about this today in the morning as a precursor to the Jackson Hole meeting, where we talked about two different things. One, the Bitcoin risk index, which is, for those of you that follow us, you know that this is the structural long-term view that we have on the price. And what basically, this basically entails some specific profit loss dynamics that deal with how people accumulate and how close they are to their actual average of accumulation. And we distill that down to the actual wallets, so the ones that are actually driving the price. So we, over the last 10 years, have been able to identify and have mechanisms to be able to do that. And also kind of aligns very nicely with what Willy does on his capital rotation analysis. So this basically told us is that we were actually looking at a similar type of structure that we saw in the lead up of November of last year into the actual last move of that, which was basically end of December into the early parts of January, so up to about the third week of January. And what is actually interesting this time around is that if you only looked at Bitcoin, you would basically say, okay, we're actually at the beginning of the next leg down. The thing is that in that time period, what has also changed is that there's been a massive strength in a rotation increase or increase in rotation of capital into Ethereum. And that is significant because right now the weakness in Bitcoin is not idiosyncratic completely, but it has more to do with the extensive rotation of capital going to Ethereum as the risk reward of not having Ethereum or the opportunity cost of not having Ethereum has gone up significantly. Okay, so weakness right now in Bitcoin is mostly due to on-chain related dynamics, specifically with the drainage of capital from Bitcoin that has actually become a net plus on the Ethereum side. And you can see that very clearly with the bottom phase analysis that you guys know very well. That was not the case back in late 2024. So we have a very different market right now. It's much more plural, not singular. What does that mean in terms of the actual Ethereum Bitcoin pair and Bitcoin dominance? Something that Henrik, I think, has done an amazing job at the last 4 or 5 months in really indicating that we were in the final stages of that strong Bitcoin dominant phase. And I think we have proof now that there's an actual breakdown and very good proof that we've actually seen the beginning of the last move in the first act. So always look at the market in 2 acts. The first act is likely to convene now in the next couple of weeks as more capital rotates into Ethereum, as the narrative of the Ethereum side of the equation really picks up in the coming weeks. And you can see that here that it has actually gone through three steps. Usually the phase or the rotation of capital culminates in 4 steps. So we're actually going to go into the most likely strongest part of that. And usually the third and the fourth act are the ones that actually pull ecosystem plays with it as well. So here we're talking about LDO, AVE, and curve. As a consequence, that creates a flywheel into other risk-on plays as well. Going back to what Willy mentioned before, we have, as you can see here, if you look at, I forgot to add the x-axis. I'm sorry for that, but this is basically beginning of 2024. This is end of 2024. What we're seeing now is the current stage. So this is actually up to date to today. What you can see here is that the actual relative strength of capital or liquidity coming into the system, so specifically the Bitcoin ecosystem, has actually been dropping ever since the beginning of last year. So the strongest Bitcoin was in February, March, April. You had a relatively strong, still very dominant Bitcoin end of last year, but look at how that has dropped off significantly in the most recent rally that started in April 7th of 2025. What's actually interesting is that look at how Ethereum has actually taken over, especially in that later part. So Ethereum actually has been relatively decent as an investment over the last two peaks that you saw also in Bitcoin. It was actually on par, so not better, but it has been significantly better in the current period. And this is due to the capital rotation. So we've actually been picking that out. And actually, this has been a good signal structurally for us together with the risk off signal that I showed before, and indicating to us that actually all the drops in Ethereum have actually been buy the dip opportunities, right? We've actually been very aggressive on the 4,100, 4,200 level because we saw that strength in capital rotation. So again, liquidity. To give you a relative perspective, Solana has been a lot more hit or miss. So it's been a lot more sporadic. It has been very dominant last year, but it has not been as dominant this year. The dominance last year was clearly due to things like pump, base, right, of things that were actually leading into speculation, so meme-driven speculation. We're not saying that that's not going to happen this time around, but the likelihood is that we're going to have more narratives dominating. Last year, I think it was again the story of two narratives. This time around, there's going to be a lot more Ethereum focus, but also ecosystem on Ethereum, right? So we're going to have things like Pepe, stuff like this. If you're into memes, I think those are going to do fairly well because they are more broad-based, right? And they capture larger let's say, stake in that speculation environment. But it is also interesting to see how we see a shift in that narrative. And again, liquidity is important to understand because it leads price action, right? It's one of the only things, and obviously I don't want to speak for you, Henrik and Willy, but from my perspective, it's one of the only things that actually leads price in a consistent manner. On the point of Solana Ethereum, just very quickly, without going over too much here, you can track that with the impulses. So where you would want to actually see is a relative ratio of impulse between Ethereum and Solana. We actually had a massive breakthrough in our framework when it comes to this on the altcoin and Bitcoin advanced vector Telegram groups. We're going to be releasing that over the next, probably end of next week or beginning of the week after, so first week of September, where we're actually consolidating all of these views and giving you basically the structural analysis, short-term, medium-term, long-term, in a very intuitive single card that you can then look at. And what that also looks at is the relative ratio of liquidity, but also the impulse. Because it's not only the liquidity and how it moves into the system, but also how violently, how strong is that move, right? Is it very fast? Is it slow? That matters a lot, especially in terms of how much it impacts basically the risk-taking within that ecosystem. And just to give you to culminate or add all of the things that I just mentioned before into one visual, here you can see it very clearly. So we had a dominant Bitcoin in basically the early parts of 2024, later parts of 2024, and a dominant Solana as well. So very clearly, whenever you have a phase that goes from Bitcoin directly into large, mid, and small caps, that is usually very speculative. Very quickly, it goes into speculation, and it means that it's unsustainable. What we have seen this time around is actually much more sustained rotation of capital into Ethereum, which becomes the new reservoir for risk-taking that then rotates into the ecosystem, becomes a lot more sustainable. So what we're expecting, and I think especially Henrik has been very vocal about this already end of last year, that we were going to see the rise of Ethereum. I can announce to you now that the rise of Ethereum is long gone. We're now in a Ethereum dominant state, and that is going to persist into the next couple of months for sure. As speculation becomes more and more dominant into higher risk plays, into memes, ecosystem plays, things like Aave, LDO, right? So liquidity staking, things that traditional finance can wrap their head around, like they can understand. That I think that flywheel is just kicked off a couple of months back and has now been clearly is a narrative that has been doubled down on. So I think For those of you that do look at the altcoin vectors, I think this is going to be a dominant thing that we will be discussing as well. So having given you a little bit of that update, we are right now in a phase, like we said before, where I think we have a tactical environment still. So we still need to break above 117,000 on Bitcoin to be truly out of the bottom. Maybe Henrik, you can talk to this a little bit once we answer some of the questions. We are clearly in a bottoming phase. So actually, for those of you that actually have access to the more advanced services that we provide, we triggered the bottom on the 19th of August. So that was when the first trigger came through. So the confluence of all of the different structural metrics that we look at. And that was also confirmed, I think, even ahead of that. I think, Henrik, you confirmed that already on Friday of last week, that we were likely already in a bottom. So the structural analysis that Henrik and Paul were doing basically triggered on Thursday, Friday of last week. We were able to confirm that on a structural statistical level on Monday of this week. So that is still not 100%. We're not 100% out of the woods, but we're significantly higher in the probability of a bottom actually playing out over the last couple of days. What's also important to see as well that we still have strength in Chainlink and Ethereum. We're actually going to get the new confirmation of this signal in about 40 minutes. So for those of you that are subscribed to our services, you will get that update very quickly. But for now, what is definitely clear is that we're in a mean reverting environment. Remember, for those of you that were there in the last webinar, mean reversion is important because the mean reverting environments are the areas where Bitcoin actually starts becoming dominant, right? There's a really strength moving back into the system. And that strength then converts into rotation of capital into Ethereum, Solana, and the rest of the risk plays basically within the ecosystem. So we want to actually see that. You also saw that in early July, right? The first move that we had, the previous first move that we had in Bitcoin was also driven in a mean reverting environment. If you go back even further, so if you take into consideration also the last real big move that we had in November, also mean reverting environment, right? So the fact that we are in that sort of stage is very indicative that we have a significantly higher probability of actually seeing massive capital rotation into Ethereum and into the ecosystem plays, along with a strong Bitcoin. That is it for my side, guys. Do we maybe want to go through some of the questions? Because I just saw that there's quite a few questions that are coming through. Actually, before I do that, sorry, I did want to quickly mention a couple of things. For those of you that are actually tracking the altcoin vector report as well, we actually did announce this already yesterday and actually the week before. So Thursday, already indicating that we were slowly going through a bottoming phase, but also very specifically an Ethereum dominant environment. So even though Bitcoin was dropping off, you had a resurgence or a kind of a phoenix rising from the ashes moment for Ethereum. So we are getting better. So obviously, for those of you that want to give us feedback in terms of how we can improve the service, we are getting very good now at really converging all of these different signals into a single point that you can track. Clearly also driven by the alert system that we're going to be upgrading the Telegram series with over the next 1 or 2 weeks. I don't know, Henrik, do you want to maybe add a couple of things to the bottoming phase? Maybe if you have some charts.
Yeah, I'm not sure I have some charts just ready. So many things on the table today, obviously because of the situation. But yeah, it seemed like Ethereum actually had at least on a short-term basis, you could see that we have a divergence on the 1 hour, which showed that we were in a correctional phase over the last few days here, and we always have rather large pullbacks in of course, something that goes up, 100% or something like that will of course also pull back, but we just don't like the pullbacks, obviously. But it's always about that to identify when it is a pullback, and that's where we have the early waves. We have the possibility of actually seeing what are pullbacks and what are more severe. When will we potentially have a top? So it was not so. It was rather obvious that this would come to an end, and actually the next phase here we should see is part of the third wave, which will take us much further as I see it. So I think there's a good chance we could see 6,000 getting hit also by this move that we're looking at right now within not a too distant future, actually.
Yeah, We're actually going to be doing a little bit of an analysis here, kind of combining on-chain the liquidity measures and Henrik's structural analysis to give a general sense of where kind of the extension targets can be relevant. But I think we've been alluding to this already in the vector series as well. But yes, stay tuned for that as well. It requires a little bit more of analysis now that we know that Jackson Hole has set the precedents in terms of the liquidity expectations. I think this is now going to be very relevant in terms of how that extension really plays out. I don't know, Willy, do you have any other points, or do you want to go straight into the questions? Because I see that there's actually quite a few.
Yeah, we can go to the questions, I think. Yeah.
Awesome. Super.
All right.
Let me see. Do you want to maybe start? You see,
I saw one in the Q&A, not in the chat. There's only two in the Q&A. One was, what percentage Bitcoin would you hold that we are holding through the bear market? We can talk about that independently, but I'm the guy that's known to sell into every bear market. How many bear markets it is? Like, I accumulated the first one, the second one, because that's when I learned about it during the bear market. I accumulated the first, I sold all of it in the second using on-chain analysis of the dead cat bounce. I sold pretty much all of it the last bear market, and also this time, yeah, it'll be mainly all of it, probably five. I might hold 5%, something like that. Generally, that's because I want to have more liquidity available to buy at the next cycle as we ramp up. And it's my day job. It's my day job to do this. So it's not recommended for people who aren't savvy with the markets. So yeah. Yann,
well, I mean, I
Swissblock.
think you also have an asymmetric amount of information and over 15 years of experience now at the end of the day, right? So
It's
hard to
definitely over
match.
10,
Yeah.
12 years, I think.
12,
Yeah.
yeah.
It's only 16 years old since it was invented, this Bitcoin. Yeah.
I mean, you were one of the OGs, right? So, but yeah,
Yeah.
it makes complete sense. I think on that point, maybe I can add a couple of things as well. I think, like I mentioned before, we've been very, very focused on Ethereum, even though we're big Bitcoin believers. I think long term, I do think that the capital right now, or the new hot narrative in town, is Ethereum, and I think it has been the case since May, ever since we really had the global bottom on April 7th, 8th, 9th. But I do think that the long-term play is Bitcoin still. I think everything else will wither away. I think Ethereum is making a case for itself. I do think that it's going to stick around, especially as we mentioned in the last webinar, the more stablecoins become prominent, I think the more relevant, or the more of a utility and use case Ethereum actually has, right? Which obviously creates a flywheel in itself. It's an ecosystem. As long as the costs are kind of kept in check, I think that will keep becoming a driving kind of flagship use case for Ethereum, right? Kind of irrelevant of anything else that might come through. Yeah.
I'd like to jump in there and say that like Ethereum, Solana, and actually most of the altcoins are, you might call them technology layers or technology startups in the Nasdaq. Whereas Bitcoin's a whole different fish. It's the only game in town with scale that can compete with the monetary assets. So, it's a challenger for gold, which is 6,000 years and is 22 trillion market cap or thereabouts. And it's a challenger if we have a structural change in monetary assets. So if we look at that as a target size of 100, 200, we're talking hundreds of trillions. That's why my bets are on Bitcoin. It's a very slow moving game. It'll take decades to get there. Whereas if you look at technology, whether, we have Web 2 technologies, we have startups now, and the thing is the underlying layer ones, they compete against each other as use cases come. And so I did an analysis a while back, and it looks like if you look at all the equities in the world, 110 trillion, only 5% of that is covering the finance sector. So just barely 6 trillion of that. So you can see there's a big disparate difference between these two games. So if we're talking not next year or next month, but decades out, the ultimate size of these assets will, I think, be dictated by what we're shooting for there. Yeah, so obviously I'm a Bitcoin maxi, but this is really how I look at it over a very, very long time hold.
And maybe I
Yeah,
should put a few words to this as well. I don't know, Jan,
of
because it
course.
says here there's also a question here. I think it's fine. I mean, there's the question of the size agreement on price action and the cyclicality. It looks like Willy and Henrik has fundamentally different interpretation of Bitcoin as an asset itself. How do you guys reconcile your differences while working on this project? Well, first of all, I mean, I can start out by saying I have the most profound respect for everything Willy has done, and as you can see also yourself here, guys, the analysis or the depth of that is second to none. So so there's nothing to go about that. But there's not one thing that speaks volume to me every time is that somebody has done the work. Willy does his work, no doubt about that. So looking at that, that's fantastic. What I'm seeing perhaps, and that's the paradigm shift. And I don't think that's maybe what's talked into this, because there's a way of looking at things from a cyclicality, but the paradigm shift that we're looking at, we all seen that inflation is now back in the game. We haven't had inflation ever since 1981, where Volcker came out and did the crust inflation. And we've seen inflation moving lower ever since then. And when you get down to 0% on interest rates, everything becomes, interesting. Because if you want to get a yield, something that goes up by 2%, also gives you a yield of 2%, is fantastic. But if interest rates are around 3 or 4%, it's not so fantastic. The problem with this easy money policy is that they have created an unsound environment, which is that things are not there is no interest rate. There's no adult in the room, so to speak, and that's the problem. We have then seen the birth of crypto, where I want to underline that the technologies down beneath the crypto are, there are things here that will revolutionize the world, no doubt about it. Am I clever enough to see that? No, I don't know which ones. There are probably guys out there or people out there that knows this much better than I do. But what I can see is that when you look at for instance, the one thing we just look at the correlation between S&P and NASDAQ and Bitcoin, it's above 90%. What we also can see is that if you look at the correlation of how much of a decline we have seen every time NASDAQ has declined, then in 2011 it declined by 18%. Bitcoin crashed by 93%. In 2014, NASDAQ declined by 13%. Bitcoin crashed by 86%. In 2018, we had a decline of 24% in NASDAQ, and we saw a crash of 84% in Bitcoin. And then in 22, we had of 35% and 77% in Bitcoin. So what I can see is that we are getting the Bitcoin outperforms to the upside and to the downside. And what I'm looking at is the largest tech bubble ever we're looking at right now. There's no doubt about it. Look at market capitalization to GDP and so on. So if we have that, and we saw that the .com brought about a 85% decline in NASDAQ, which I could easily see us having this time again. I'm just saying, with the correlation we have seen, and with what the overperformance of NASDAQ, of Bitcoin versus NASDAQ, I could see a very, very large crash. And then further on, put onto this that we are now moved into a new inflationary regime. It's very visible. I put the chart up many times on Twitter, where you can see that the yields have moved up, and we are in a new regime. It's so clear, actually. I probably should just put it up there again after this talk here, which means that over the next many years, inflation probably is going to go higher. And if there's one thing that a non-yielding asset does not like, then it's probably that. We'll have to see what the real yields is going to be. And if they're going to have inflation, it's going to maybe be a little higher than what the yields are going to be or the rates are going to be. But I just say that in an environment where the alternative and the safe return alternative is going to be higher because yields are going to be higher, those kinds of assets could actually, suffer. And again, in a deflationary crash, I would not be holding anything. And I think the crash can be much bigger than most people anticipate or expect. So, but again, I'm 50. I may be the boomer, and now, Willy, you're even probably older than me, even. So maybe you got more experience then. But I'll be the boomer here. and say that I think that is a possibility. And I just wanted people to be aware of this. But when we see that, it's still the opportunity to actually, ride the tides and the when things are going in and out. It's about understanding when the turns are there, and that's also where we have the framework from our side, which can help you effectively navigate that. And that I think is a fantastic thing.
Yeah,
Yeah,
and I think
I'd also
go ahead, Willy.
I would also say there is no disagreement really. Like I think it's in time frames. I'm talking decades out. Um, it turns out Bitcoin is the most sensitive to liquidity changes, and we know that it draws down very, very hard. So just bear that in mind. It may dump very heavily, and I kind of agree with Henrik that we're in for this is no different. We're in for a bear cycle. People are thinking maybe it's a lesser drawdown because it's structurally stronger. It's got institutions behind it. Those institutions, a lot of them will, well, a lot of the institutions that do put money in can also take it out quickly, particularly in the ETFs. I think that sure we'll have a bear market for sure, just like every other past one. The question is where do we go with this asset over 10, 20 years? And I think it's potentially very, very high relative to the original conversation around layer ones like Ethereum and Solana.
Yeah. And I think what also makes us unique, right, especially this panel here, is that I think we've gone cumulatively through 3 different cycles. So I think we have a generally good understanding of how far the elastic band stretches from a liquidity structural perspective, where we know that things, like Henrik always says, nothing goes up in a straight line, nothing goes down in a straight line, right? It's always more complex than just, is it going up or going down? It's always a but or if, right? And our goal here is to be able to provide you guys with a more structured way of looking at things, keeping in mind the principles that matter, right? And those principles revolve around risk management. It revolves around not over leveraging. It revolves around really getting a sense of when the risk reward is in your favor or against your favor, right? And I think this is what we're basically mostly interested in. And it really kind of stems from the point that we made in the very first webinar that we did together, which is at the end that Bitcoin is a liquidity transfer mechanism. It's a canary in the coal mine for liquidity expectations. If expectations are positive for future liquidity, Bitcoin is going to go up. If it's negative, it's going to go down. And Ethereum is going to be exactly that, but even more volatile. Solana even more than that. And the further you go in the risk curve, ending at memes, that's where it becomes super volatile, right? So 10x up, 10x down, right? And we just want to give you more of a perspective in terms of how to manage all of these different criteria into something that is much more repeatable and robust. So maybe just to go through the questions, because there's actually quite a few that came through here. Maybe just very quickly, not to make this about the Ukraine war, but there is a question about if the Ukraine war is going to be, or the blow off top that you've been talking about, Henrik, if that ends with the cessation of the Ukraine war.
It's never we like to, as human beings, to put it up to something of a special event that we feel is special to say this is the thing, but really it's not as important as I said, as Mrs. Johnson there. So the Ukraine war, there will be, if you can just go through your history and look at every time we have had a war breakout, it could be the NATO bombing of Serbia back in the 90s, or the outbreak of the Iraq war back in 2003, and so on. You did not see any, it didn't create a bear market because of that. That's again not what drives the business cycle and the economy. We like to put that in the media, and then it's like an easy way of telling things. But the thing is, the economy is a complex thing. It's with thousands and thousands or millions of variables that are in there, and of course there is something there called the war and uncertainties and so on, and this can of course have an impact, but it's not what drives the business cycle. So I don't think that this will have a direct impact on things. It has, of course, there will be. If there is some kind of a ceasefire or anything, and we can all hope for that, and peace, but it will not be something that will then all of a sudden say, okay, then the bear market or the recession is off. That's not how I see it.
Yeah, it's more like the structure, kind of it's ebb and flow, and then these things tend to catalyze, right? So they may accelerate a already existing process. In the same way, we'll not go too deep into this, but I think we're probably very similar in our thinking on basically side of all the changes that Trump has done on the basically on the trading front, right? Where these things are not the cause, but they're really more of an extension of something that's already going down, right? So the deterioration has already come before. It's not the reason, but it's one of the catalysts that actually kind of put the last nail in the coffin, right?
But
on the
absolutely.
tariffs,
I think, unfortunately, Trump is gonna, and it's not because I support him like that or do not or anything like that. What I'm going to say is that unfortunately, it's going to be pinned to his name. What we're going to see, I think, and it's not to talk politics here, but just to say that that's really not it. The reason is that the hubris, as I see it, of the central banks over the years, where we think we can just print wealth, and we do that by just lowering yields, lowering rates, forever, and printing a lot of money, or raising our balance sheets levels. That's what they have done, and that has created distortion in the economy that is going to play out at some point. A bubble cannot last forever, and there is a bubble. I mean, just look at it; it's so easy to see. So as you said, Jan, of course, if there are tariffs and things, it's not going to help the situation, because by everything else being equal, having tariffs will lower trade, and trade is good for growth, and which means that it's not a good thing, but it's not the thing.
Fully agreed. And we'll go into more in the weeds, I think, in the coming webinars. This is more to just kind of make that point very clear. Next question, and last is on Ethereum, Bitcoin. I think we talked about this quite a bit, but I don't know, Willy or Henrik, we see it outperform Bitcoin, right? I think we would probably agree with this in the short term.
Yeah. Yeah, I think it's pretty clear, and I think if you do the combination of the Bitcoin dominance, which has a clear, so we talked about it many times. Yann said it's gonna break, because you can see it from the structure, and now it's breaking lower. And then you look at the same time, you see the Ethereum Bitcoin ratio actually moving higher, and having had a very reversal kind of look to it in terms of the technicals, which now shows, and we're going to see this strong move. So so those are the ones we need to look out to, also to understand how far can this rally go, because I think it can go quite a distance before we see any top.
I would say one thing in that just be aware that there is a large amount of Ethereum that was locked up in staking, collecting some yield, is unlocking. And so you can only presume that unlock is because of the price rise, and they want to sell into that liquidity. So there will be a time where it turns, and don't bet on it. We're not in this flipping world where it flips Bitcoin right now. Those guys have weathered a very, very hard bull market, meaning that Bitcoin rallied, whereas Ethereum never made new highs. So, and also this cycle has demonstrated, particularly last cycle it started, but this cycle it really demonstrated that Ethereum has a challenger, which was Solana. And so it's not like a single layer one will have network effects that others can be challenged. They can be challenged by newcomers. Solana obviously being faster and more suited for different types of applications, and more will come. So just bear that in mind over in terms of a fundamental analysis long term. Yeah, so there will be sell pressure coming.
Absolutely. For those of you actually that follow Negentropic on Twitter, we actually did a tweet thread on that exact point. So Willy is fully right. We will get some headwind going into the first weeks of September. I think I haven't talked to you specifically about this, Willy, but with Henrik, I definitely have. I do think that we're going to get a correction in September. I think a more significant correction as people take profits off the table. It will coincide with the fourth leg, based on the presentation that I shared before. But that won't be the end. And we have different reasons to think that. We'll be releasing some of those thoughts over the coming weeks as well. But I think for now, it's all about the expectation of liquidity. And I think that's going to be the thing that carries us over the next couple of weeks. If I'm not mistaken, Willy, I think the unlock happens, I think it was 19 days last week. So it's probably like 2 weeks. And there's another 7 to 8 days as it trickles into the system. It's like it's not all at once. It's staggered.
Yeah. And there's also a queue. So there's a rate of unlock. So it'll take a bit of time for that to chew through, but it'll hit roughly.
It's not all self pressure, right? So there is also a reason as to why some of these larger stakers would like to consolidate different wallets. So there is part of it is due to that, but there's about, I think, 1 million plus worth of Ethereum that is definitely on the sell pressure side. But yeah, we'll be tracking this as it evolves as well. On the altcoin vector, can you explain what confirmed or unconfirmed means, please? What is the base on this? So remember that all of the stuff that we talk about here, the frameworks, the signals, etc., they're all based on systematic quant trading strategies, right? So we've been the hard part in that is that we're trying to take that from a quantitative environment where they're constantly, very precise and accurately trading back and forth into a more quasi-static manual type of regime, right? So it takes a little bit of iterations to get this right. On the Telegram, we went from opening up the entire funnel, which is a lot of different alerts, into getting into shape as well that is visually appealing and actually understandable. So the next step in that evolution is going to come within the next 1 or 2 weeks, where we consolidate that even further into really understanding what about the impulses and the confirmations, where they come from. That comes from understanding, are we in a strategic or tactical environment, right? Remember, a risk-taking or a risk-managing environment, strategic risk-taking, tactical risk managing, and really kind of sewing or weaving that into the process. But in terms of confirmed, it basically means that you have a lot of different things that basically create confluence. So there's many different measurements that are independent that are telling you the same thing. That's what we mean by confirmed. Unconfirmed means that it's maybe one, right? So we still have to wait to get more confirmations and really more, how would you call it? Like more conviction that is actually the right thing that is actually happening, right? Next question for Henrik. Hi, Henrik. I've been following your work. Following your great work on macro analysis for over 5 years. Big fan. Could you help to understand your March analysis on Nifty 50 for 72% decline? Do you still see Indian economy rolling over while US equities hit all-time highs? Good time to buy or wait for next year business cycle over once it's over?
I think we updated that view when we had our Indian version at some point, where I said I think we could see that actually the Nifty 50 could move higher, much higher, and actually it was only a correction that we had. So we did get a top there, and we did see the correction when I said it, but we that was only a part of a correction. So or a smaller correction before we see the all-time high. So I actually think the Nifty could do quite well here as well, following the blow-off of the US markets, and maybe even, as we've seen before, also top out a little later in the US markets. They can do that. So I haven't looked at the Nifty just the last few weeks here, so that's why I'm a little weaving a bit here. But yeah, I have a much higher target on it right now, but I think it will also take a very big hit in when we see that when they see the recession hitting.
Fully agree with that. Next question. So Ethereum is being adopted by Wall Street. From a tech perspective, Sol Sui seem to have the edge. Will Ethereum be able to accommodate the TPS and other elements needed from an AI and Web3 agentic world? Is this just Tom Lee, or did Vitalik rescue the roadmap? It goes back to what I think Willy mentioned before, right? I think I think Henrik alluded to this as well. There's a tech discussion argument about the infrastructure, the plumbing, and how we build kind of the Web3 and kind of the evolution of the internet when it comes to value, right? This more fungible, dynamic, programmable value proposition that is not just the linear kind of one-dimensional thing that we call cash or currency, right? And I think it's still way too early to understand how that progresses. I think what is definitely clear is that in an agentic AI world, it's all about tokens, right? And the sharing economy of how tokens move within a system that has very low friction and allows for services to really propagate towards marginal cost to zero, right? Where it's all going to be about specificity. It's about access to a lot of different services at very low cost. Going back to Henrik's point, deflationary type of environment, right? Technology over long periods of time tends to be very deflationary by definition. But it's still unclear. I think when it comes to Ethereum and adoption of Wall Street as a narrative, I think that's going to be on the short to medium term. It's going to be the narrative because people can grapple and understand what Ethereum actually is in terms of from an investment perspective. it's less clear what it is from a technological perspective. And I think, to Willy's point, Solana and Sui are still part of that discussion. There's no winners yet in terms of who's actually going to be dominating that in the decades to come. But it is a tech that is still way too early to understand. I don't know, Willy, if you want to add anything to that.
Yeah, I agree with it. I still feel like we're in Mt. Gox days of this technology. 2013, when exchanges were very not robust. It's still to be seen from my perspective whether or not this technology will work, because everything runs through smart contracts, all the computers in the open. One mistake in the code base can blow up, in the case of Aave, ridiculous amounts of money, multiple billions, tens, hundreds of billions of dollars, soon to scale to trillions. I'm not sure if the finance infrastructure is ready to be put on those rails where you're updating the code base every, say, a year, and for new features, and potentially, blowing up the entire app. And so, yeah, I watch it in terms of, is this ready to carry trillions of dollars of capital? I think we're very far away from that. We see a lot of hacks consistently every other week. I'm sure North Korea loves this. But to me, it's yet to be seen if this is even the right path. For now, it's a very popular experiment. Yeah, let's give it some time.
Actually, that's a really key point. We are still in an experimentation phase. I think Bitcoin is the only thing that is out of the experiment. I think there's clear utility. Bitcoin has become a macro asset. I think everything else is still too connected to Bitcoin. If Bitcoin fell 20% tomorrow, everything else would get absolutely destroyed, right? So there's still that very strong tether to the underlying anchor that is Bitcoin. And I think it's going to take a lot more time, probably maybe one or two additional cycles for us to really understand how things kind of propagate from that central utility value proposition that is Bitcoin.
May I just, again, as the boomer and the guy who likes history, also just point to that in 1840, in 1920, and in 2000, we had technology shift, and they all brought about a bubble. And just that we have a technology shift does not mean that any investment in it will be a guaranteed success, and there will be a guarantee to your investments. Again and again, we see, if you look into those bubbles, that the technology did shift and did change the world. No doubt about that. The steam engine, the locomotive, in the 1920s, it was cars, radios, and so on, electrification. All this changed the world. But still, people lost a lot of money. The same with the internet in 2000, lost a lot of money into a bubble. So we need to distinguish from what is the real use and what is the real, purpose of all of this technology, which may be, lost in the fog of excitement. And go back in then, there were thousands of companies also in 1840s popping up in the railway because you had a steam engine. That is just what I want to say is take care. There's a euphoria around these things where things will move up and everybody can see that it's going to change the world. But nobody can actually look right through it and understand this before we actually get to the end. And there will be hundreds, if not thousands, of businesses and setups that will not be profitable. And I just think that the history that, look to it, it's worth, diving into that to understand that the euphoria that we see around this may not be met with a return in the longer run. So that's the only thing.
Yeah. People tend to overestimate what can happen in a year. They tend to underestimate what can happen in a decade. I think that's a human condition, unfortunately, that we have to deal with. The next question: what about XRP? XRP right now is a call option on Ethereum. It's again. Remember, people like narratives, right? So Bitcoin has a clear utility. It's a safe haven to some extent for some people. Like it has. You can explain it, right? If your grandmother asks you, what is Bitcoin? There's a way to answer that question. I think with Ethereum, there's a growing narrative or conversions of narratives that make it easier for mainstream to understand. Ripple, Solana, they don't have that yet. I think Solana to some extent because it was the meme coin or the casino of crypto, right? So people could associate with that. Ripple does not have that yet. So I think it is still a little bit like Cardano to some extent, right? Where it has potential, has an ecosystem, but it doesn't have that clear call to action USP where you're like, okay, I associate Ripple with that one thing, right? With that label. So I think you can trade it. I think it's a higher beta play to Ethereum, like you said before, but ourselves, we don't know enough about it to give you a very concrete underlying answer. Maybe Henrik and Willy do. Us as Swissblock, we don't really. What do you guys think about treasury companies? Yeah, sorry, go ahead.
No, I have no further comments on XRP.
Okay.
Yeah.
Next question is on treasuries, Metaplanet strategy, Sharp, Link. I think that's your expertise, Willy. What do you think about that? How is that going to create the flywheel, and what are the risks that we see on that front?
On premise with microsailor, it's to tap bond markets and now people who want a steady yield with the potential offerings. So I think that he's producing a product that people want. Like, for example, if you don't want to buy Bitcoin because it's too volatile, maybe you're retired, you can't weather that volatility. Maybe, you might be down for a number of years with this before you get back up to your purchase point. That's not really the kind of investment instrument you want going into your retirement, but Michael Saylor is producing that. It is relatively complex. He is using his common stock and using ATMs on that to fund a steady yield in the case that Bitcoin goes down in price. And so it is a product that people want, and in the long term, it should fuel capital into Bitcoin through this type of investor. There's other people like, say, Metaplanet that are, using clever ways, which are a synthetic ATM to get more and more Bitcoin. A lot of these companies, which are, I think it's in a bubble this cycle. It started really ramping up lately, and so there's so many being offered. And the ones that are generating the highest yields, Bitcoin virtual yield, they're getting a lot of attention. The NNAs are expanding. You need to look at the debt structuring. Some of it is very weak. They wouldn't survive a prolonged bear market. And Metaplanet in itself, I looked at that one, and if they get the timing wrong, they could be partially liquidated. So bear that in mind. If you're buying, I wouldn't recommend buying into these instruments as you approach a blow off top, because those MNAVs are going to compress, and you might be subject to even a partial liquidation of that treasury, and if the debt structuring is weak. And then, the follow on altcoin treasury companies, we know how far they fall in a bear market. So it's going to be great riding it up, but the other side, if you don't time that perfectly. So on the bonus side, that if they're trading at a high MNAV as the market turns, then it's relatively it's kind of like a put option, because as the MNAV compresses and as the underlying asset compresses, you get a kind of a bearish squared activity. So it's not bad to short that in the bear market if you're a trader.
Actually, Henrik, I think, loves the idea of shorting specific treasury plays, right? So specific tickers.
No,
But I think
I'll be very clear, and especially companies in the US now seeming to put Bitcoin on their balance sheets. These are small time bombs that is ready to blow off when the time comes. I mean, it's it's virtually speculation with something that is extremely volatile, and putting in on the balance sheet of a company that has nothing to do with that kind of business. It may work as long as Bitcoin goes up, fine. But if I'm right on the severity of the next decline, it's not going to be a good thing. So, but I think going into this, yeah, it can go much higher. So, of course, I think it's a leverage play at this point for some of these for Bitcoin and Ethereum actually. But let's see about it. But it will become a problem down the road.
Yeah,
I would say that though I think most of these will blow up. Totally agree with Henrik. I think strategies structuring is very, very bulletproof. I wouldn't want to weather a bear market with it, but I don't think it's going to blow up because their debt structuring is 8 to 12 years out. The NNAVs are not that high, meaning that Michael Saylor can ride on Bitcoin for 8 to 12 years, and if it doesn't beat the current price of Bitcoin in 8 to 12 years times the NAV, then he'd be in trouble. But I don't. I think Bitcoin would be in trouble if it doesn't get that kind of ride over. We're talking a decade out. And all the new stuff is very, very robust against liquidation. The other stuff, very high risk. And when I say other stuff, all other treasury companies that I've looked at so far.
Yes. Just to speed it up a little bit, so I'm going to combine two questions. There's a question about the SPX 6900. So the Murad thesis about memes becoming a new generation of assets. Again, it goes back to the same point. I think to Henrik's point, I think there's going to be a lot of speculation, tulip mania type vibes, where it's just a mispricing of the asset, right? Where nobody really understands where the value actually comes from. And I think that basically induces a lot of volatility. So I think memes are really the most volatile thing that you can trade in crypto, period. That being said, in a blow off top, especially in a stable and growing Bitcoin type of environment with Ethereum picking up its slack and Solana following through, memes are a way to basically play with additional leverage, right? Meaning, I'm not saying that you should take leverage. I'm saying that it is think of it like a levered play on Bitcoin, just buying the spot memes because they are super sensitive to expectation liquidity and for risk taking, right? We actually use an index internally that is meme based to be able to gauge how risk averse the environment basically is. And I think to that point as well, I think there's another question about the WIF specific situation. Yeah, I think WIF still has a lot of upside. I think Henrik is maybe more, this is more of a question for you, but structurally it seems like it has been basing for quite a while. And that one will leave the station very quickly once it does move. So once risk starts moving into that direction, or the risk taking starts to become more prominent in that kind of meme ecosystem, I think WIF will do very well. But it's going to be a double-edged sword. So make sure that you don't look at it as a store of value, because it isn't. It's a completely speculative, high risk.
It is not. Yeah. It's not. And I just want to say I am into that, and I still have my views on in terms of the target. I think it can be quite extreme. But and I'm also my son also wants to get into it. I said, son, it's shit with shit on. But for now, it goes up in price, and you may be be good and earning some money on that or getting a return on that. But it's not something for us to store as value. Absolutely not. Absolutely not.
Yeah, and following through on that, on the opposite side of the spectrum, talking about bonds, there's a question of the 30-year bond yield above 5%. And more specifically, what are the signs that we see for bear confirmation? So macro bear, I think there's a couple of things. I'll let Henrik speak to it more, because I think that's his expertise. But I think for me, it's going to be the sell-off or a drastic sell-off in gold, which usually are reserves for funds, larger asset managers. So when we see a big liquidation on the gold side, that's going to be indicative of a liquidity crunch. So that's not going to be a good sign. And I think a fast falling yield on the 2 to 10 year, right, Henrik? So
sure, absolutely. These are, but also the what thing that people don't expect also, but the bottoming of the dollar here, which I think is not right here time wise. We're not there, but in terms of level, we are not so far off. I think there's a little lower level coming to it, but that will be a sign also when that turns in the bigger perspective, and it starts to head up. That is one thing. The yield levels by themselves, yield spreads by themselves. Also, credit spreads will be something we need to look at, and there will be also Fibonacci levels and so on. There will be a lot of, and that's why we don't just triangulate these things in terms of trying to figure out where it's at. It's we 6, 10 angulated to understand when is it that we start to see a potential top here. What will be the and in terms of the economy, it's really the things that we can see in the market, but there are the weekly jobless claims, and they normally start to rise when the economy starts to deteriorate. We are not really seeing that yet. So we again, that gives us an indication that we still have time.
Yeah, and I think on that point as well, in terms of the cycle timing, I think Willy also mentioned something in the last webinar. I think there's structural reasons to believe that Bitcoin is going to give us the indication when things are really going to start turning as well. Something we will probably see simultaneously in gold as we see the sell-off. But I just speaking for myself, I think it's within a couple of months. I don't think we have a year, like a lot of people on nicely with a super cycle. I'm going to be more conservative on that, and I think take advantage of the next couple of months. It's going to be volatile. I think we're going to get big upsides and downsides. That's why risk management matters. I think the framework that we provide through the Vector series is going to be valuable to just gauge that risk reward profile that I think is super relevant or super important. But if I had to guess, gun to my head, somewhere in October. It could be, I think, in an extreme situation, we go into the end of the year.
Yeah, I agree. Completely agree.
I'm picking early October, but I also hedge that with that's the hot zone. I actually think it could start there, but look, tops are unstable, and it really depends on when everyone starts to flee all at once, and so it's very hard to predict that. But I think October is the hot zone, and then it can pan on forward. It could even pan on to 2026, but I don't give it good odds on that.
A good side is actually going to be equities. I think this is where obviously Henrik's expertise and what you've actually been very crystal, kind of like a super accurate and precise on. Yeah, you're going to have equities topping out, and it's going to be with volatility spikes. So it's going to be bought up very quickly, but it won't really move higher. And I think that's going to be one of the telltale signs of a big inflection point. We haven't seen that yet. Let me see. There's a couple of other questions that have come through. Yasmi, I think that's on you, Henrik. I think high beta play on Bitcoin, right? It does well when Bitcoin does well. Yeah,
exactly.
So we probably see more upside on that one. Yeah.
And we are probably in the phase also where this should start to move, and then we'll see some of the memes coming later because Jasmine has a purpose, you could say, and then this probably could be no recommendation or anything like that, but yeah, probably could do well in this kind of environment we're moving into.
Yeah, there's another question, a follow-up that came, I think maybe from what we said before. So yes, if you do get a blow off top, and we get a top in October, between October December, whenever that is, right? Then do we get a dead cat bounce? 100%. Like Henrik always says, things do not fall in a straight line. So you're going to get recoveries as greedy or late shorts come into the mix. They get liquidated. You get an artificial move higher, and then kind of the next leg down. In the same way, we're kind of seeing that on the bull structure that we're currently in. So yeah, it's going to be volatile. I think non-linear for sure. The key question is also going to be: does everything top out simultaneously? Do we get a 2017 type of environment, or is it a 2020, 21, right? It's kind of do equities, gold, Bitcoin, everything kind of top out into one cumulative liquidity squeeze, or is it more staggered? I don't know, Henrik, if you have an opinion on that. I'm not sold. Bitcoin is definitely going to be more reactive. I would say that much.
Yeah, I think there are some more similarities to 2017 if you look to Ethereum Bitcoin ratio, and also if you look to the Bitcoin dominance. So that could speak in favor of this looking more like that kind of top than it did the 21, which were more in a. If you look at the Bitcoin dominance, it was more of just a midway kind of thing. So I think if I had to guess, I think it's more like 2017, but still also 2017. I wasn't around in crypto back then, Yann. Both you and Willy were. But I think there was still, as I've studied it, there were still some weeks in difference between the top in Ethereum and in Bitcoin, at least as I can remember it. But you guys can probably talk more about that.
Yeah,
I think the last cycle was interesting. When you talk about dead cat bounce, I kind of think of that second high that even went higher, which people think is a cycle top. I think of that as a dead cat because the fundamentals weren't there. The fundamentals were falling away, and it was driven by paper bets, and it was very much our first cycle of heavily driven derivative instruments that were scaling up in size. And I think that may have skewed Bitcoin's behavior relative to traditional markets because the price chart was not really printing the fundamentals of spot. It was printing some kind of DGN paper and sort of ramping up. And so I think that might have been the reason for the last cycle being a little bit messy relative to the others. Yeah, whereas this time spots come back to Bitcoin because of the spot instruments and treasury companies. So I think it'd been a little bit more orderly relative to TradeFi.
Yeah, I fully agree with that. Actually, you would probably say as well that the kind of peak or all-time high Bitcoin, the real all-time high was in May 2021, probably, right?
Yeah.
Yeah, I fully agree with that. There's actually many indicators that point to that exact moment. And I think with our framework, we're going to get the actual all-time high right. If we're then lucky enough to get a kind of a paper induced further all-time high, I think that's a cherry on top, right? But I think those types of situations you should be doing or playing with less capital, right? So as long as you have the majority on the sideline, you do it very, kind of sporadically, and I think opportunistically, then there's really no real downside, right? It's always a question of capital scaling, position sizing, basically. The last point, what about fiscal stimuli? Will governments not kick the can down the road in 2026? Are recessions tolerated? Of course, they're not tolerated, but I don't think the government controls
but
what a
nobody,
recession looks like.
it's never been tolerated. Nobody ever wanted a recession. I mean, it's not like there was a president who said, "Oh, I'll just let the recession go," or any central bankers. It's because they don't see it. It's because they are looking at the in the rear window. So the thing is that yes, they could do that again. But the thing is, as I said earlier, the regime has shifted. We are now in an inflationary regime. When we ask your granddad or your dad about what does stimulus mean, what does fiscal stimulus mean, they will say, "Oh, in the 70s, it meant inflation." And that's the thing we have now. I know we don't know about that because it's been like this for 20 years now. And the inflation has been heading lower all the time until 2020, which was the inverse Volcker moment. Now things have shifted. We are in a new inflationary regime, which means that if the central banks do this, and they will, believe me, they will, then they will get something out that is quite different, which is that maybe the economy will not bottom out as fast because Mrs. Johnson there in the US say, "Oh, I've seen inflation, I've seen rates going up, and I've lost my job." Do you think she's going to spend those $100 that she will save? Or if she can get a stimulus check, she'll say, "I'll go spend it immediately." If she does not, it means that then you'll have the cycle effect will then become even less, and that means that it will not have the same kind of impact. So we think that the Fed and the central the administrations is kind of potent here, and they are not. They are not omnipotent. They cannot trigger an upside. If it was that easy, we will have we will all be rich. We'll all be millionaires, and you can just keep printing money and stimulating things. The problem is inflation, and we just seen it. And the human psychology is also that if we see these things in inflation rates hike and losing our jobs, we're not going to spend those money. So the thing is that the times have changed. This is actually different. This is one of the things that is different. Inflationary regime, which means that the tools that they used 17 years ago or in 2020 have now become less useful and actually can work against what they want to do, which is that they don't want inflation to rise and they want consumption to start moving up again. So that's why.
Think of the economy like a petri dish, right? That has like chemicals that are kind of interacting with each other, creating chemical reactions that create things, right? Like it could be whatever. And what they're basically doing is that they're just adding more chemicals. So they're adding one type of chemical, which short term might create more reactions. But if you have too much of one thing, it actually creates the opposite effect, where you kind of you subdue the reactions. And that's basically what Henrik is talking about, right? Where demand is the reaction. We want interactions, things colliding with each other, engagement. You can't fabricate that. That is not something you can just artificially create out of nothing. They've tried that. That's called communism. We just kind of top down say this needs to be done, right? But in a free kind of in laissez-faire economy, it's all about the reactions, and it's all about facilitating more reactions, right? More collaboration, more interactions between people that create products and services. And I think this is really the misunderstanding when it comes to the kind of the supply side monetary policy dogma that we're living in. Yes, hard assets long term. Yes, I think as far as I know, Henrik has been a pioneer on this concept with the commodity super cycle that is going to come at some point. But I think we first get a major correction, liquidity crunch, and then out of the ashes, or the phoenix that rises out of the ashes, will be a commodity hard asset driven type of situation, which, by the way, Bitcoin will be part of as well, I think.
And there we may differ in opinion, but let's see about that.
Exactly, but this is where the
I love to be wrong.
the boomer and the Gen Z
If the boomers,
divergence.
but expect, you can ridicule me if it does. I'll stand with that, but also admit if I'm wrong. But I will say that I think again things have shifted, and that's what we're going to see. And look at the chart. Look at ratios, guys. Look at that ratio of S&P versus gold. Look at the chart of Bitcoin versus gold. And I can tell you, Bitcoin versus gold right now is very bullish, but it looks like it's going to reach the top at some point, and I think you're going to see that it's going to be very, very bearish.
Yes.
That means that Bitcoin has to overperform, gold has to overperform, and I think that time is coming. So the gold guys are going to get it at some point. I'm quite certain. So, but again, I'll admit if I'm wrong. Let's have another one.
But
down
the
the road.
governments are always gonna opt for the easy solution, which is always going to be expanding fiscal and monetary policy, right? So, I think,
There's one thing I would add, and this is contrary to Henrik's view, is that look, I know that Henrik's very savvy in the market, but Bitcoin is not a mature macro asset. It is the youngest and newest, and behind it is a technology adoption, and that's very much my world, where we measure things in an adoption S-curve. And we're really not even at 5%, around 5% adoption. So, but that's counted in the number of people that are adopting it, holding it. And it doesn't, there's two things. There's people that are comfortable holding it, and then there's the size of the capital that's coming in and out of it, which is really the big driver of price. But never discount the number of people that hold it, which is getting close to 500 million people today. And that's going to start climbing exponentially. I know that it's spreading in Latin America, Africa, places that need it, but it's very, very little capital. But come one day, this cohort will have wealth, and that capital will come in. And so what's driving it right now tend to be the rich people, the Westerners, the asset managers, the family offices that can actually put a sizable capital right now. So, take a long view of it. I'm not talking this month, next year, next 4 years. I'm talking about many cycles out into the decades. This asset will inflate in size and will challenge gold. I think that will happen, and it will challenge the size of the US dollar.
I definitely am more in that camp as well, but it's going to take time, and I think it's the path and how we get from A to B that matters a lot, and I think that is a risk, a managing of risk path as well. So that's what we are really focusing on.
You know what I mean for you two guys? You know what I mean for you two guys? If Bitcoin does not crash below 10,000 in this next crash,
that again, I think it's going to be volatile. So maybe 10,000 is crazy, but maybe actually to the lows of the last time. I can fully see that. I think I've seen crazier things happen. So I wouldn't bet against that, Henrik, at all.
No, but that's then we'll just have a live webinar from the dinner.
We are we're very close to an all-time high in Ethereum, by the way. There's a very, very good chance here that we actually start pouncing or pushing through with liquidities as well, or liquidity, short liquidation starting on the upside. So just keep looking at that chart. Very interesting. Last question, I think, because we are, quite a bit over time here. Indicators signal a spot spot the approaching top. It's a liquidity game, guys. Like Willy has said many times before, it's understanding the structure. Liquidity is going to be the precursor. It's going to be the canary in the coal mine to understand when price is starting to become kind of too visceral, right? It's kind of basically just hot air that is just kind of drifting into direction, kind of like what Willy mentioned before with 2021, where the second half of 21 had no fundamental backing. It was just basically paper speculation. I think we're going to be able to isolate that very, very well. It's hard to say then what happens after, right? Because tops, they always are the same and are never the same. Sorry. Bottoms tend to be very, very similar. Tops are very different by nature. So I think we're going to have to take that one step at a time. But I think a drastic deviation between fundamentals and the price is going to be a very key indicator of that. And the liquidity is going to be the thing that tells us how relevant that deviation is.
Absolutely. Got nothing more to add. That's a very good summary.
Awesome, guys. Unless you guys have any other points, thanks a lot for taking the time to listening on the webinar. We'll be probably doing a couple more of these in the next couple of weeks. We'll be informing you over Twitter. I think also email. But
I think we should have a shot at posting this also to our Substack channel. For those
Yes.
that don't know, we run a Substack now, but the Bitcoin Vector. Is there another one? You have one up there on Substack as well, Henrik, right? Your leader.
Yeah.
But we really launched the Substack for the retail side of people that want to understand the structure as they're holding this very volatile asset. Best times to buy. Not really designed for the traders. The professional traders should be in the Bitcoin Advanced plan with live signals. But at least the light version does give you an idea of structure so you can manage risk.
Absolutely. Very good point. Thanks a lot, guys. Have a good weekend, and yeah, we'll keep in touch over the coming webinars.
Thank you.
Thank you.
Bye bye.